Imagine waking up one morning, checking your investment app, and realizing your money has grown while you were sleeping. Sounds great, right? But here is the million-dollar question. Should that money be sitting in ETFs or individual stocks? For beginners, this choice can make all the difference between steady growth and stressful volatility. Today, we will break it down once and for all. ETFs versus stocks, which is better for beginners. Welcome back to Rich Map, where we make money, investing, and financial growth simple and smart. If you are new here, do not forget to hit that subscribe button and turn on notifications so you never miss video that could change your financial future. Now, when most beginners start investing, they usually face one of the toughest decisions. Should you buy individual stocks like Apple or Tesla, or invest in ETFs that give you a whole basket of stocks at once? Let's explore both sides, understand the pros and cons, and figure out what makes the most sense for you. Let's start with stocks. Buying an individual stock means you are owning a small piece of a company. If you buy 10 shares of Apple, you literally own part of Apple. If Apple performs well, sales go up, profits rise. Your stock value increases. But if Apple struggles, your investment can drop just as fast. Stocks can bring high rewards, but they also come with high risks. You have to research companies, read financial reports, understand their business models, and sometimes make fast decisions when markets change. For beginners, this can feel overwhelming. And honestly, it's easy to get emotionally attached to your investments. You see a stock going down and panic sell, or see it rising and buy at the peak. That is why a lot of beginners lose money early on. Not because the market is bad, but because emotions take over. Now let's talk about ETFs, short for exchange-traded funds. Think of an ETF like a big shopping basket filled with dozens, even hundreds, of different stocks. Instead of putting all your money into one company, an ETF spreads your risk across many. For example, an S&P 500 ETF includes shares from 500 of the biggest companies in America. So even if one company in that group performs poorly, the others balance it out. This diversification is the biggest reason ETFs are often recommended for beginners. They let you invest in the overall market without needing to analyze individual companies every day. You buy one ETF, and boom, you are instantly invested in dozens of top companies. It's safer, simpler, and less stressful. Another big difference between ETFs and stocks is time commitment. When you invest in stocks, you need to actively manage them, track performance, follow company news, and sometimes rebalance your portfolio. But with ETFs, you can invest and basically forget about it for a while. It's more of a long-term, passive approach, perfect for people who do not want to spend hours watching the market. Let's also talk about costs. With individual stocks, there is no management fee. You buy and hold, but you might need to pay transaction fees depending on your broker. ETFs usually have something called an expense ratio, which is a small annual fee for managing the fund. The good news is, most popular ETFs like Vanguard or iShares funds have super low fees, often below 0.1%. That's cheaper than hiring a financial advisor and still gives you expert diversification. Now you might be thinking, which one makes more money? The truth is, both can. Stocks have the potential for higher returns if you pick the right ones. But that's the key. You have to pick the right ones. It takes knowledge, research, and sometimes a bit of luck. ETFs, on the other hand, usually deliver steady, average market returns. You would not get rich overnight, but you will also avoid massive losses if one company crashes. Here is an example. Imagine two beginners start investing with $1,000 each. One buys shares of Tesla, and the other invests in an S&P 500 ETF. If Tesla goes up 30%, the first investor makes $300. Great, but if Tesla drops 30%, they lose $300. Meanwhile, the ETF investor might make a more modest 8% return, earning $80. But they sleep peacefully, knowing their investment is not depending on one company's fate. So, for most beginners, ETFs are the smarter way to start. They give you instant diversification, steady growth, and peace of mind. Once you've learned how markets work and build confidence, you can start mixing in individual stocks to aim for higher returns. Think of it like this. ETFs are your financial foundation, and individual stocks are the upgrades you add later. Let's also talk about control and excitement. With stocks, you feel more in control. You are picking specific companies you believe in. Maybe you love Apple products, or you believe in the future of clean energy, so you invest in Tesla. That personal connection can make investing fun and motivating. ETFs, on the other hand, are less emotional. You are not betting on one company's story. You are betting on the market as a whole. It's less exciting, but more reliable. The best investors often use both. For example, they might keep 80% of their money in ETFs for safety and long-term growth, and 20% in individual stocks for higher potential returns. This strategy balances stability with opportunity, a smart way to build wealth over time. Before we wrap up, here is something important. No matter which path you choose, consistency beats timing. Whether you are investing in ETFs or stocks, the key is to keep adding money regularly. The market will go up and down, but staying consistent and thinking long-term always wins. Do not chase trends. Do not panic during dips. Just stay invested and let time do the work. So, if you are a beginner wondering where to start, ETFs are your best friend. Simple, stable, and perfect for building a solid foundation. Once you are comfortable and more confident, you can start exploring individual stocks to boost your returns. Remember, the goal is not to time the market, it's to spend time in the market. If you found this video helpful, give it a thumbs up, subscribe to RichMap, and share it with a friend who is just starting their investment journey. Your financial future is waiting. All you have to do is start smart. Thanks for watching RichMap, where we help you grow your money step by step. See you in the next video.